Hello from Otet Markets. This is Ahura. We'll be with you to review the U.S. labor market data and market reactions. As you know, it's the first Friday of February, when the U.S. non-farm payroll reports published. The report is including the data for January, and we will see these data how the numbers were first, and then we can see and check the market reactions as well. So as you know, as you can see here, actually, in January, U.S. labor market created only 140,000 new jobs, much less than 169,000 or 170,000 market expectations. However, the unemployment fell to 4% from 4.1% in previous months. The main reason is because of this number. The December number which at the first at the initial numbers it was about 250 or 260,000. It increased to 307,000. So which means in December we had already 307,000 newly created jobs. So that caused the unemployment rate to fall to 4%. That's what even thought the participant rate increased to 62.6 from 62.5. So, which means the participant rate is very low, and unemployment rate is fell to 4%. The December initial estimate revised up to 307,000. And more importantly, average incomes increased by 0.5% on a monthly basis. And that increased the annual average earnings to 4.1%. Both of them, they are in the historical levels. I don't say that the best level, the best historical numbers, but they're in the historical levels. That's very rare happen to see the earnings, average earnings increase to 0.5% on the monthly base and 4.1% on the annual base. It's not something normal we can see. In the US, it's about 4%, 3.9%, 4%. 4.1% is something that we can see here. So here. So that means these numbers means that the US labor market is very strong, at least at the moment. Even thought the GLTs were lower than expected, but now with these numbers, we can say that there is people, they are making more money. And when you can make more money and the unemployment rate is low, it means that the people's income is high. And when you have more money, you can spend more, so the demand in the market can increase. And when you have more demand in the market, it means the prices can still stay higher. So the companies or the sellers, they have no reason to lower their prices. Why? Because there is a demand. So higher demand, more demand increase the opportunity of increase the reasons for the central bank in the United States to hold the rates for longer to control the inflation because of more demand, which as expected. More demand comes from there because the people they have more money to buy and they have more demand. More demand means the sellers they have no reason to lower the prices. When you don't lower the price, it means that inflation will stay higher. So the central bank will have no choice to hold the current rates or even increase the rates to control the inflation. So the higher for longer is the scenario that we can understand and we can expect after these numbers. That's why the semi-group FedWatch tools, the holding the current rate percentage increased to around about 90% from 85% before the data published. So right now there is about 90% chance for holding the current rates compared with 85%, which we had just like 3 hours ago before this data published. So these numbers, if you look at the market reaction, it's very normal to expect the US dollar to get stronger after this data. So this data means higher for longer, for more demand for the US dollar, and the US dollar at least can end the downtrend that we had after the previous jump and in the 4 or 5 days, the previous 4 or 5 days. So the US dollar with this number can get more stronger, and we can expect the number is around 108 mark for US dollar index. When the US dollar index increasing, it means the pressure on the stock on the gold market, because XAU USD, so it means that the gold against US dollar. So it can put some pressure on the gold market. But at the same time, higher for longer for the rates means negative data for the stock market. And when you have the negative data for the stock market, so the sell opportunities in the stock market, they take some cash out of the market, which goes directly either to US dollar, either to gold or US bonds. The gold here will have a demand. On the other hand, maybe the bonds will have a more demand right now because they have a more interest, but still the gold also will have a demand. So these numbers, they can be at the first hours or that the first reaction, they can be negative for gold, but generally that's the positive data for the gold. So in a long term, still gold is a buy and we can expect higher numbers for the gold. But on the energy front, when the stock market is not in such a good condition, and at the current situation, we cannot with these numbers and with like stronger US dollar. So these numbers cannot be positive for the energy or for the energy market or even for the gold, for the oil. So these numbers cannot encourage the oil market, but they can encourage the US dollar and can support the gold in mid and long term. But it's a negative for the stock markets, which you can probably see the reaction in a few hours. If you go further for the cryptocurrencies, then it cannot be such a good news for the cryptocurrency, but it can be somehow the negative news for the cryptocurrency because of increasing the risk of the inflation, higher inflation. But at the same time, maybe some people, they say that the cryptocurrencies, they are anti-inflation assets, so it's a positive for the Bitcoin. But I don't believe that I don't believe in Bitcoin as anti-inflation with the too many CFDs and other options that we have right now in the market. So it's not going to be anti inflation. It's going to even increase inflation. So that's why it cannot be a good number for it. It cannot be the good actually numbers for or the good reasons for the buy opportunities in cryptocurrency market. So anyway, that's not a positive for the Bitcoin. Maybe they can just like initial reaction can be positive, but it's not a good reason to say that the Bitcoin can go higher. So that's the market reaction. That's the US labor market data and market reaction, and what we can expect from the market. Actually, we have to wait and see how the investors will react to these numbers, but generally, this is what we can expect from market with these published data. Thanks for watching this video. If you had any other questions, don't forget to write in the comment section. I will try to get back to you as soon as I can. Have a good time. Bye-bye.